This is one of the most reliable reversal structures in technical analysis. Don't blink when an ending wedge forms. Breakouts get violent and fast. Hi, my name's Ian Coleman and I'm a senior analyst at FXStreet. We released a short video on this reliable pattern and received many comments asking for more information. We've got you. Let's break down the ending wedge formation. There are two types of ending wedge formation. The first is called a rising wedge, and this is a bearish formation. The second is called a falling wedge, and this is a bullish formation. For ease of explanation in this video, we will stick to the rising wedge formation, but it can be noted that all the information can be applied in the opposite direction. What are the key aspects of the ending wedge? The ending wedge formation is a highly reliable pattern to spot a change of trend. It usually works out identifying a trend reversal between 65 and 70% of the time. It is often seen at the end of a trend. It signals exhaustion, imbalance, and a move into a new phase of market behavior. The key aspect is convergence. This is when the swings contract, making a funnel-shaped apex. As price stays within this pattern, the swings become smaller, momentum wanes, and it gets ready for a violent breakout. So why are the moves so aggressive? Well, we have trapped traders who continued to buy on higher highs and higher lows. We have stop orders triggered on the breakout. And lastly, we have compressed volatility. This is when traders flip from bullish to bearish. How do traders use the ending wedge? There are three potential entry levels. The first is a spike above the trendline resistance. This is a high risk setup that is known as a liquidity grab. We will cover this in more detail later in the video. The second is a solid breakout candle. This should close towards the end of the candle, showing that sellers are in control. And the third is a retest of the breakout line. Markets will often come back and test the breakout line to ensure that the signal is solid. Please note, this is not the breakout level, but the breakout line, which is normally at higher levels. So where do we target? Most traders will look at 100% of the pattern or the start of the wedge formation. The second target can be a liquidity pool at lower levels. The ending wedge. This pattern is the dream of every market psychologist. Although the structure looks simple, the ending wedge formation carries deep implications for the psychology of market participants and the liquidity conditions. It really highlights how these factors drive price. Smart money or institutions enter the market and they start building long positions. Although we continue to see higher highs and higher lows, traders begin to doubt the strength of the rally and they start to take profit early. This reduces the upside momentum. Fewer traders are willing to enter this late in the trend, and professional traders and institutions are starting to unload their long positions that they quietly accumulated at lower levels. Unwise retail traders will often continue to buy purely based on higher highs and higher lows. Price will continue to make new highs, but momentum indicators, will they fail to keep up the pace? This highlights bearish divergence and it shows the underlying weakness of the current rally. We will often see one last spike higher above the trendline resistance. This is a liquidity grab in a stop loss hunt. As price breaks lower, the liquidity pools that were previously formed from stop loss placements are triggered. It will normally lead to an aggressive move lower as these standing protection trades are triggered. How can you use the smart money concept to identify an ending wedge pattern? Where are the warning signs of a change of trend? Stick around, I'm going to show you. So the basics of an uptrend are higher highs and higher lows. The smart money concept, or SMC, defines each move higher as a break of structure This is denoted by a line and an abbreviation of BOS on the chart. We can see that with every move higher, the rallies are getting shorter. A potential trend change is when we see a change of character. This is when we have gone from making higher highs and higher lows to a lower low. Now this is the first warning sign of a potential change in trend. The failure to make a new higher high and a break of the change of character level is our confirmation. This then highlights that a new swing high is in place. It should be noted that the last break higher above the trendline resistance, this can be seen as a liquidity grab. It's an obvious place for retail traders to place their protective stops. What are the limitations of the ending wedge? The structure is extremely reliable, but it's not perfect. It can fail based on various factors. If the current trend is extremely strong, then any move to the upside could just be corrections. We could see strong breaking fundamentals, and they can override most technical patterns. And lastly, we could just have poorly drawn trend lines. Let's discuss the pro tips. Look for the breakouts to be impulsive with strong and solid candles. This tells us that one side is dominating price. Always look for built-in divergence. This highlights that the trend is dying. The reverse trendline resistance is the most reliable entry level. Always calculate your risk to reward ratio. We will be doing a video on this subject, so look out for that. It's also advisable to take some profit at the first target. This pattern can sometimes turn into a bearish head and shoulders formation, and it will push higher before the next sell-off. That's an in-depth look at the ending wedge formation. Which technical pattern would you like us to cover next? Drop it in the comments.